This is SFNet Presents In the Know with host Barry Bobrow, sponsored by Hilco Global.
Hello, and welcome to SFNet Presents In the Know. I'm your host, Barry Bobrow, Managing Director and Head of Credit Markets for Regions Business Capital. Through these In the Know video and audio podcasts, I'll be bringing you a series of conversations with thought leaders on important topics impacting the secured lending and asset-based lending markets. Joining me today for what I know will be a brilliant and insightful conversation about the leveraged loan markets and the trade association that represents market participants, the Loan Syndications and Trading Association, is Executive Director of the LSTA, Lee Shaiman, a good friend of mine for many years. Before we begin, I just want to make an important disclaimer. Statements and opinions that Lee and I are going to make today on this podcast are our own and do not necessarily reflect the opinions of our employers or the Secured Finance Network. Information provided should not be relied on and are interpreted as accounting, financial planning, investment, legal, or tax advice, and references to websites or companies, if we make any, should not be construed as endorsements or recommendations. You should consult an appropriate professional concerning your specific situation and irs.gov for current tax rules. Okay, so that out of the way, thanks in advance for watching and listening. I really do welcome your feedback on today's discussion, as well as your suggestions for future topics and speakers. Lee, great to have you. Thanks for doing this. We planned this, I don't know, about a year ago, and we just never got around to actually doing it.
Now, thank you for inviting me, Barry. This is great. I'm really looking forward to the conversation.
Absolutely. Well, I hope it's like all the other conversations we have that meanders around and covers a lot of really important things. Lee, before we start, maybe you could just give the listening, the watching audience a little bit of your personal background, which is a great background, and how you came to be heading up LSTA.
Sure. So I started in the finance industry, I guess officially in 1982. I went from a couple of years in public accounting. I worked for the old Deloitte, the predecessor to Deloitte, so Touche Ross, for a couple of years, got certified, joined a firm that's now all kind of rolled up into UBS. And actually a lot of the firms that I worked in my background kind of all ended up rolling up somehow into UBS, strangely enough. But I started at Blythe Eastman Dillon, which became Payne Weber, ended up leaving, and I was in corporate finance for a number of years, worked my way up to running a high yield underwriting group within the corporate finance department, made a career change shortly after I guess a couple of years after the 87 crash, right after Drexel folded, and went onto the research side with the idea that what I really wanted to do was to go into the buy side. No one was going to hire a retread investment banker at that point. So I was a publishing analyst at Dillon Read for a couple of years, focused on high yield. Ended up leaving there and starting a business, strangely, at Swiss Bank, which ultimately bought Dillon Read and ended up merging with UBS a few years after that. I ultimately did leave for the buy side in, I guess, 1999, and joined a firm that was one of the pioneers, particularly in the CLO space and leveraged loans, and that was Indus Suez Capital, which is part of banking. So there's a there's a whole alumni of former Indo people who are still very involved in leveraged finance, particularly leveraged lending and mid-market leveraged lending, that are sort of all over the street. Right. We moved that business to Royal Bank of Canada, and then ultimately became part of GSO, which ultimately merged into Blackstone, and is now, I guess, really the kind of the DNA of what's now Blackstone Credit, which is, I don't know how many hundreds of billions of dollars they have under. That's right. Yeah, it's incredible how much they've got under management. When I was at GSO, I was on the board of the LSTA and really enjoyed what the LSTA did. And I think I really being on the board, particularly during some tough periods of time right after the financial crisis, the risk retention issue, and if you know the some of the issues around Dodd-Frank, creating the need for risk retention capital for CLOs. So just to finish up on my background, left Blackstone or left GSO Blackstone at the end of 2015. Went to a smaller firm to help that smaller firm raise risk retention capital, a smaller CLO manager. We did put a risk retention fund in place, and then the opportunity really came about that the incumbent executive director, Bram Smith, was, after 9 years at the LSTA, was retiring, and there was a search on. So threw my hat in the ring, and here we are. I'm about to finish my 6th year as the executive
I think Bram
director
came in as an interim, and maybe you did as well, and here you are 9 years later. So,
yeah. So it's there's a long history.
Yeah, talk about LSTA. What for folks who are involved in the leveraged lending space but probably don't know exactly what LSTA does. Talk about the trade association.
So the LSTA is 600 members, all institutional members. So we're kind of the who's who of the leveraged finance industry. But interestingly, the LSTA is somewhat unique among financial trade associations. We represent both sides of the market, the buy side and the sell side. That's who our constituency is. It's who our membership is. So, it's anything from a small manager with a couple of CLOs or a few separate accounts. We have some hedge fund members. We have most of the major and some smaller law firms that are service providers to the industry, the accounting firms, even some of the vendors and software providers, and of course, the large institutional managers and the large and medium banks, the money centers, as well as the super regionals, such as your employer, are all members. We like to think of the LSTA as sort of the research, standard setting, and policy voice of the syndicated leveraged loan industry. And what our main goals here is to facilitate a fair, transparent, and efficient loan market that supports America's companies. So while borrowers are not members of the LSTA, and we've really not had borrowers as members, I guess you could argue that some of the large PE shops that have credit arms sort of are derivatively members of the LSTA, but that's not, our main focus is really to improve loans, ensure that financing remains available by trying to grow the market, improving the market through standardization and efficiency where that makes sense, standardization of documents, the development and encouragement of best practices. We publish market advisories. We're engaged in bankruptcy issues. And then we spend a lot more.
That might be the biggest touch point that you have that coincides with the asset-based market, since we're also heavily involved with restructuring and bankruptcy. And I know our respective counsel have worked together on a number of briefs over time.
Yeah, and we've worked with the association that you're now you're an officer. You're the chair of on a number of issues.
Of Secured Finance Network.
Okay.
Yeah,
that's right. So we've worked with the staff of SFNet on some bankruptcy issues and some other issues where there's a commonality. We work with a lot of the other trade associations, from BPI, which is the Bank Policy Institute for some of the older folks. That was the clearinghouse back in the day. We're involved with the ICI, the Investment Company Institute, the Managed Funds Association, the American Investment Council. We do a lot with SIFMA, of course, SIFMA, and SIFMA, the AMG arm of SFMA. That's the asset management group within SFMA. So there's a lot, and government policy, and for lack of a better word, I guess to some degree, although I would say it's not technically lobbying, government relations, government policy, advocacy for the loan industry is a big part of what we do.
Mm-hmm. So, and I was, I should have said this at the top. I was on the LSTA board, not at the same time you were, many years ago, and have a very strong feeling of the professionalism and the success of the organization. So that's why I wanted to have this discussion today. But I think maybe it would be helpful to talk about what your major initiatives are having. I guess the biggest thing that took up time over the last few years was LIBOR cessation, LIBOR transition. Is that completely done? And where's the association spending its time today?
Yeah, so I would say that the LIBOR transition is done. It's so done to the point where my colleague Meredith Coffey, who really led the charge, and I think probably dedicated most of the last 6 years of her life to, and she was actually a formal member of the ARC, which was the group by the Fed in selecting SOFR, ultimately selecting SOFR as the replacement rate for LIBOR. But and it consumed a fair amount, not very little of my time, a lot of general LSTA time, a huge percentage of Meredith's time, and then Tess Vermani and Ellen Heffernan, two other of our senior staff members, also spent a lot of time. In Ellen's case, it was the operationalization of SOFR. Tess was instrumental in the drafting. She was a lawyer, associate general counsel of LSTA, now actually taking over as head of policy. Meredith will be leaving us at the end of this year. I think she's completely burned out by SOFR, but that, I mean, that's not the main reason. She's leaving to pursue.
Job well done. I mean, the transition occurred, and there were really very few disruptions in the market, and we've transitioned over to SOFR. So what is consuming the energy and time of LSTA today?
So unfortunately, we've been, I think, more reactive than proactive, and even during the SOFR transition, as I mentioned a bit earlier, the federal government, particularly the SEC, and most specifically the SEC under its chair Gary Gensler, has been extremely busy. They've got over 20 rules that they've proposed, some of which have already been effectively enacted in their final form. But at any point in time over, let's say, the last 30 months, there's been 8 to a dozen issues. Most of those issues have been issues dealing with the SEC, where we've actually we've met with the commission, we've met with the various commissioners, we've met with the staff, we've met with the staff of the various commissioners, we've published, I'm not sure exactly the number, between 12 and 15 comment letters, fairly voluminous and quite detailed, under the Administrative Procedures Act. There's a notice and comment period in each of these cases. So we've published, on our own, and advocating for the positions of our market and our membership, in taking issue in many of the cases with what the commission is proposing. Right now, some, as I said, some of those proposals have been passed in final form. We've actually joined 5 other trades in suing the SEC on the private funds that they passed, I guess about almost 4 months ago. where basically the SEC is looking for the types of disclosure and really the kind of reporting that in a private fund environment that's similar to what publicly registered funds are required to do. Believe, as do the other trades that are part of this litigation, we believe that the SEC actually does not have the statutory authority for that rulemaking, and so we filed a lawsuit against the SEC. So that's in process. We filed our brief about a month ago. The SEC just filed its response, and we'll be filing a response to their response, the way the court system works here, sometime mid to late January. But in addition to that, I think one of the more existential issues that we're actually in the midst of right now, both from the perspective of comments that we have made and follow-up comments, working with our membership, but also really I would say in a healthy dialogue with the SEC, and that's with the mutual fund liquidity risk management rules that the SEC proposed about a year ago. Those rules are part of some other issues relating to hard close and swing pricing issues for mutual funds. They also posed a number of rules around need for liquidity. There's clearly a mismatch for bank loans in daily liquid mutual funds and how long it takes a bank loan to settle a trade. So from the time of trade to the time that loan turns into cash, loans are not securities. They don't settle they don't settle through depository trust clearing corporation. There's a whole different mechanism through the private markets, and there is a lot of operational friction associated with that settlement process. The SEC has taken issue with that over the years. We've worked with our membership over many years to try to improve settlements. Frankly, we haven't been all that effective in reducing settlement times, although really look at when a buy-side firm owns a position at which it is selling, settlement times are significantly shorter than the average median or mean settlement times in the market broadly. It's a little nuanced, but it's true and supportable, and that's the important issue here when we're talking about daily liquid mutual funds and bank loan settlements. That said, I think there's room for improvement. I think the market can improve. I think there's a lot of new software coming and some technology that can be applied, but frankly, a lot of the issues around loan settlements is really behavioral. And so it really isn't that hard to improve settlement times. I think it's harder often to improve behavior across a market.
Lee, let me tap into your many years of experience here and just think about markets for a second. So in the aftermath of the COVID pandemic, loan market issuance in really late 2021, first half of 22 reached crazy new highs. Loan market, institutional, and the bond market too. When rates started moving up, that obviously curtailed, but the increase in the underlying rates has raised yields. They've moderated as of this conversation in the last month, but to levels not seen in the lifetime of most market participants. How would you frame in that context the health of the leveraged loan market today, settlement issues aside?
So I actually think the loan market's quite healthy. And let me explain. I think, first of all, Barry, the point you make an excellent point. And the market grew fairly dramatically, even before COVID. I think if
Right.
you go back post, the recovery for the global financial crisis, I think we saw from that period up until the point of the Fed starting its round of tightening, which I guess the market seems to have read stopped last week, but we'll
Yeah,
see.
we'll see.
I'm not necessarily a believer. You're supposed to listen to to what the Fed actually
Hey,
says.
don't be a buzzkill here. I mean, it feels
Yeah,
really good. 8 days in a row
yeah,
of record on the equity markets.
exactly. But
Feels good.
you got to be careful that you don't get too much candy because you get off the sugar high.
Right.
But so I think that our market responded to quantitative easing like every market did, and so I'm sort of thinking that the last almost 2 decades is actually the aberration, and fundamentally, what you've got to look at is credit and credit quality. And yes, we've seen a small spike or a small increase. I think spike is too strong a word in default rates over the last, call it 18 months. But it's still the default rate is still quite low, and it really does feel like the recession that everybody's been worrying about, wringing hands over for, again, more or less the last 18 months, somehow hasn't seemed to take place, and we're in this sort of soft landing. So I think default rates are much lower than the market general expectations are. And certainly when you look at how the market has been structured, with CLOs an important part, about almost 2/3 of the holdings of bank loans that are structured, with the expectation that there's going to be both defaults and recoveries, significantly below par. So I really do think the loan market's in quite good shape. And if you look at returns in the loan market's been one of the best return markets this year. Now, the last 6 days that you just cited, the high, we're starting to see other markets really pick up, particularly equities. But loans have turned in, sort of 8, 9, almost 10%. Private direct lending, which has kind of become very, very popular and very interesting and available to all sorts of investors, institutional and retail, through business development corporations, are turning in returns even above that. So if you think about the syndicated loan market, it's been around 9% this year. So I think the loan market's in good shape. It will shrink probably. There's no question. I think the syndicated loan market, it's a bit smaller than it was last year.
That breaks a long-term trend, right? I mean,
it does.
So let's talk. You mentioned the private credit, and I think that's where you're going with it. But through the last 18 months, the growth of the direct lending business vis-a-vis the broadly syndicated market has been, everybody's talking about it. It's extreme. Is that an aberration also? Do you think or do you think that's a long-term trend that we'll see more of?
No, I think the growth of private credit is a long-term trend, and I think that really they're two sides of the same coin. I think there is a place for both the syndicated loan market and the private direct market. I think that the loan market has always been a market that has been a bit innovative and worked to find solutions for borrowers that worked for borrowers, and solutions for lenders that work for lenders. And I think that what we're going to see is over time, we're going to see an ebb and a flow between these two markets. I think the major difference is that in the syndicated loan market, there's an expectation that that the lender can exit the position through a trade, that there's supposed to be liquidity, and there's supposed to be a secondary trading market, and there's a structure around that. direct lending, the expectation is that you're really a buy and hold investor. And or a buy and hold, it's a little more like old-fashioned lending, except that the entity is not a regulated bank. It's typically a professionally managed credit manager who's raised private funds, institutionally or otherwise, to lend to companies, and those terms and conditions will be slightly different based on the expectations
Well,
of those lenders.
so the direct lenders, in exchange for essentially holding it, uh, generally want a higher return and
That's
more
right.
structure, and that I think defines in the simplest way the difference between the two markets is the
That's
pricing
right.
and terms are always going to be more attractive, but the certainty of execution and maybe the no need for liquidity results in you have a more direct relationship between the lender and the borrower. I guess, Lee, my question, the one that I'm hoping you can enlighten me on, is if so much of the credit market is shifting away from, as you say, the regulated bank entities or the CLOs even, which have some regulatory oversight, towards direct lending. Is there a risk there, a systemic risk that gets created, or do we have does the regulator need to figure out how to take a better look at the broader market?
So first, that's actually one of the work streams that we've been involved with. First of all, I don't really see systemic risk. I think first of all, most if not all of the direct lenders are actually regulated. They're typically regulated as registered investment advisors, just like the advisors are in syndicated loan markets, whether you're the manager of a CLO or the advisor of a mutual fund or the advisor to an institutional client. So that it's that same regulatory regime. So it's not an unregulated market. I also think that people shouldn't conflate this notion of systemic risk and regulation. I think through my career and through yours, many of us have seen where regulation actually is the catalyst for systemic risk or some downturn in markets. We've seen it across different industries. For example, the deregulation of the power markets, the deregulation of transportation, airlines, and so forth. In each of those cases, we saw some pretty significant dislocation of markets as a result of a regulated market that became an unregulated market because sort of a sudden. And so I don't necessarily see regulation as something that will be the catalyst for systemic risk. I think what you have to look at is what is the size and structure of the market? Who are what are the expectations of the participants in the market? What types of risks are those markets taking in terms of credit risk? How aggressive are they in terms of their standards in analyzing those risks? So, and I don't see either the syndicated lending market, which is probably about, I guess, round numbers, $1.2 trillion today, and the direct lending market where there's a fair amount of debate and there's a lot of question exactly how you define
Let's call it
or
a
how
trillion.
one defines that market, but it's probably somewhere around $1 trillion, give or take. And there's a fair amount of dry powder there as well, but maybe there's about $1 trillion drawn. I don't think the combination of those two markets in and of themselves are sufficiently large enough to really be the transmitters of systemic risks. Now, can they be? Or, I think they're, the kinds of risks taken, then it depends on the investors. I think if there are investors or lenders who are, making poor credit judgments on the underlying and then levering, those investments, imprudently or in a fashion that maybe, the market, they're not matching properly long and short. Term funding, I think those can be places where you create systemic risk.
In my time on LSTA, which was I was a young man then, but I was so impressed with the governance of LSTA, and I know it's a bit of a divergence, but I thought the things that I learned from my time there around the strength of the bylaws, the rigorousness of the nominating committee, the term limits, were all really exemplary, and I've tried to take a lot of that with me in my nonprofit roles since then. I wonder if you could I don't know if you agree, I hope so, but I wonder if you could talk a little bit about LSTA from a governance standpoint and what people might take away from its own rules.
Yeah, I agree with you, Barry. I think, one of the things that organizations like this have to do is they really do have to focus on a number of things. One is we have to represent the membership. That's why we're here. And the membership has to, and so we're supported by members, we're financially supported by members. Obviously, we hope that the value proposition to the membership is one that continues to engender their financial support, but also we need a good board, and those all require really thoughtful processes. One is to make sure you have good directors serving on the board. These are people that are giving their time, who are already pretty busy. And we want really good board members who will help us, direct the organization strategically. I mean, otherwise you have an organization that's of, by, and for the staff.
Mm-hmm.
And, the organization's going to fall short somehow. So I think it's really important that we have good board members, that we really have a process to find those board members. And you also want people to want to be a member of the board. I mean, I think you saw that in my experience when I was on the board, is really had a lot of participation, and we get a lot of participation from the board. We ask a lot of the board. I think I'm probably the biggest pain in the ass in the market because I'm always asking these guys, for something, whether, for their time or to join a committee. We just went through the nominations process, and it's a very serious process. It took, I think the process was completed over probably about a 9-week period. We started right at the end of the summer. We went out and we identified and solicited people. We asked board members to solicit people to run for the board. We had a search committee. The search committee we have is a very strong committee. We require that all members of the search committee, the nominating search committee, be current or former members of the board, preferably in leadership positions. And we're really, so that when the nominating committee talks to and interviews potential board members, they can speak from their experience.
Mm-hmm.
What does it take as a board member? How much of your time? And we have a political action committee. We don't demand that members contribute, but we encourage members to contribute, and most of them do it out of their own pocket. So
I also thought the last piece of it that I took away was the LSTA routinely challenges its mission and updates its strategy, reflecting changes in markets. And I feel like you've done that a couple times in your 9 years.
Yeah, no, absolutely. And that's how I think that's why we've been able to grow membership. When I took over from Brom, we were 450 members. Now, you pointed out earlier, and it's true, the market has grown, but it hasn't grown that much, and we're over 600 members. Mm-hmm. So we've been able to expand the membership, and we have different categories of membership, and a lot more of our members have stepped up into higher categories, which means they're participating in more of what we do. So it's really been great to see that.
Lee, I'm gonna end there, but I know that your tenure with LSTA is coming to an end. There's a search on, and
Yep.
not too much longer. So, for what it's worth, I want to thank you for your service. I feel like the industry is better for your time here, and it's been a pleasure working with you and getting to know you better over time.
Well, thank you very much, Barry. I enjoyed this, and I enjoyed our friendship. And I can promise the membership that they're going to be in good hands. We're fairly far along in the search process, and we're down to a couple of really excellent candidates.
That's great.
So, all right.
This is the end of our podcast. I want to thank Lee for participating. I want to thank LSTA for allowing Lee to participate. I want to thank Secured Finance Network for being the sponsor of it. And I also want to thank Hilco Global, who is our sponsor for the In the Know podcast.